How much would the global economy be disrupted if one of the world's most critical oil routes suddenly shifted its rules? The Strait of Hormuz, which funnels nearly 20 million barrels of oil daily and around 20% of the world's liquefied natural gas, has effectively been closed since March 1st, following a sharp escalation in hostilities between Iran, the United States, and Israel. Recent reporting suggests Tehran may allow only a limited number of tankers to pass, and only if shipments are transacted in Chinese yuan. The stakes could not be higher. A single policy decision in this narrow waterway could ripple across energy markets, finance, and geopolitical alliances worldwide. If Iran proceeds with these restrictions, the immediate consequence would be an unprecedented realignment of energy trade. Global oil prices, already the highest since July 2022, would likely surge further, exacerbating inflation in energy-dependent economies. Financial markets that operate primarily in US dollars would face sudden disruptions as the yuan gains traction in pricing and settlement for crude exports. Beyond economics, the move would signal a shift in power, where control over energy flows intersects with currency influence, challenging the dominance of the dollar as the global reserve currency. The ripple effects could extend to humanitarian operations in the region, with the UN warning that restricted passage could severely impede aid delivery. The historical roots of this crisis are embedded in decades of tension. The Strait of Hormuz has long been a strategic choke point, controlling access to roughly a fifth of global oil exports. Iran has repeatedly used threats of closure to leverage political and economic concessions. In recent weeks, US and Israeli military strikes targeting Iranian sites have escalated the situation, reportedly killing approximately 1,300 people, including senior officials in Tehran. Iran's response has been swift and assertive, effectively closing the strait and signaling a willingness to trade access for yuan-based transactions. Key actors are driving both the military and economic dimensions of this conflict. The United States seeks to maintain freedom of navigation and safeguard dollar-based global energy markets. Israel is focused on neutralizing perceived threats from Iran's military infrastructure. Tehran, facing military and economic pressure, is leveraging its geographic control and energy exports to reshape trade terms in its favor, while China sees an opportunity to expand the international use of its currency in global commodity markets. The timing of this maneuver aligns with broader global trends. Oil markets remain highly sensitive to supply interruptions. The start of the Russian-Ukrainian conflict in early 2022 caused the last major spike in crude prices, and experts warn that additional disruptions in the Strait of Hormuz could surpass those levels. For nations heavily reliant on imported energy, even a short-term blockage could trigger cascading effects on industry, transportation, and household costs. Two what-if scenarios illustrate the gravity of the moment. In the first, Iran fully enforces yuan-based trade, drastically reducing US dollar transactions. Energy importing nations could face currency volatility, supply chain disruptions, and a forced re-evaluation of strategic oil reserves. In the second scenario, partial access is granted, but only to selected nations or companies. This selective opening could strengthen China's influence in the Middle East, increase competition among global buyers, and create a bifurcated market where dollar-denominated oil becomes a premium commodity. Both outcomes carry major implications for economic stability, political alignment, and military planning across the region. Recent developments underscore how quickly the situation can evolve. Iran's partial closure followed military strikes from Israel and the US, highlighting the interconnection between kinetic operations and global energy security. Oil prices have reacted immediately, reflecting not just market anxiety but the tangible risk of supply bottlenecks. Analysts note that Tehran's willingness to accept yuan payments signals an attempt to circumvent US-dominated financial channels, which could establish a precedent for other energy-producing nations seeking alternatives to the dollar. Geopolitically, this moment is a litmus test for alliances. The United States and its partners must balance deterrence against escalation. If military pressure intensifies, Iran may respond by further restricting tanker access or extending threats to neighboring Gulf states. Conversely, if diplomacy and negotiations succeed, limited access in exchange for yuan payments could temporarily stabilize energy flows, but also embolden non-dollar trade in strategic commodities. Global powers are now forced to navigate a complex web of energy security, currency influence, and regional stability, all under the pressure of real-time events. The consequences extend beyond immediate markets. Energy-dependent economies, particularly in Europe and Asia, are highly sensitive to disruptions in the Gulf. A prolonged closure or significant rerouting of shipments could increase fuel prices, pressure fiscal budgets, and even contribute to social unrest in countries with limited energy resilience. At the same time, the potential normalization of yuan-denominated oil transactions could accelerate a broader realignment in global finance, challenging the long-standing supremacy of the US dollar and reshaping the rules of commodity trade. Reflecting on the strategic calculus, Iran's approach demonstrates how geography and energy leverage remain central to global power. By tying access to the Strait of Hormuz to a specific currency, Tehran is projecting economic influence alongside military deterrence, creating a multidimensional tool of statecraft. Meanwhile, the US and allies face the dual challenge of maintaining open shipping lanes and reinforcing the dollar's centrality in global trade, even as tensions rise. These dynamics underscore the intersection of energy security, military power, and financial systems in ways rarely seen in modern crises. In conclusion, the events unfolding at the Strait of Hormuz reveal the fragility of global energy security, the risks of currency dependence, and the strategic ingenuity of nations under pressure. Whether Iran moves to fully restrict passage, enforce selective access, or negotiate terms through alternative currencies, the global economy and geopolitical balance will be affected. What happens next will not only test the resilience of energy markets, but also determine the future interplay of military power, financial influence, and international diplomacy. The world is watching a narrow waterway, yet the implications extend across continents, currencies, and alliances, offering a stark reminder that control over energy and trade remains one of the most potent levers in international affairs.